Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for November 14th, 2019. I'm going to start you with the lowest frame we can, which is down here on the 5. We can even go back to the 1-minute chart, but we're going to build a perspective of why we're looking for range expansion, because we got a ton of range contraction right now. We'll also build our high impact, low probability, or high probability, low impact. We'll talk about what that means in terms of if you're a bettor. We're going to bet on some range expansion. Just like we've been saying, the probability favors the downside. But if the market does burst to the upside, I think you'll see a lot of short squeeze or bullish activity flood the market. And even though that's the lower probability outcome, I think that'll have a higher impact on the market. So we'll talk about those and more in tonight's video. Now we're looking at the 5-minute chart of the S&P futures. And all we're saying here is it's a chop, it's a slop, and we're defining out the high of this range at roughly 30.96 and the low of the range just about 30.84, give or take a few points in the S&P. Now if you are following volume profile, the red line is the point of control. We'll take a look at that in a moment. But this lowest time frame does talk about chop. And this takes us back in terms of framing. Tuesday session, Wednesday session, Thursday session. We have China news. Most of it's been bearish, given that they're going to withhold tariffs or not talk about tariffs, make a deal, not make a deal. It doesn't matter. It's resulting in chop in the financial markets. But all we're saying here is that there is a short-term trading range, and we know at TheoTrade that contraction, which is this chop and bar overlap, tends to go before expansion. That's what we're looking at. We'll actually pull up to the 15-minute charts of both of these, just taking a look at where we are. And we talked about the lower time frame range contraction. You're going to see it take place at even higher time frames. That level still exists, 3,095, and we could even draw maybe a rising trend line here to connect into 3082. Let's pull it back further to the 30-minute chart. Now we're getting somewhere, and all this chart is over here is just without any type of indicators. So we have the range expansion. So remember, range expansion or high volume or high price movement, trend days, or just directional movement gives way to range contraction. And this is guiding us on the intraday frame and in our swing trades. So the volatility is contracting. Volume, similarly, is contracting, which means going down as the days go on. And we're at the midpoint of November. And what does this suggest to us? Range expansion. Dominant thesis, as has been the case, will be a sell swing against 3,100 in the S&P futures at least. And again, we are traders. We are not forecasters. I wish it were that easy to say the market will go down because it's got divergences, but it is probability. And because a lot of traders are seeing the same thing, taking defensive positions, which is the correct strategy, if the market bursts above 3,100, 3,125, in fact, we can take a look at it in this perspective. We do have the weekly expected move, which intersects 30, 25, 30, 26. So we could easily see the market get to that level, which means if Friday starts off in a bullish gap or bullish open, we may see the market 25 or some odd points higher, and that would keep this concept, I'll sort of show you how that tends to work, of this uptrend going within our context of weekly expected moves. So we're just connecting out the price, and we're right here. Again, 50-50 chance of going up or down. If the trend is a guide, it might actually favor some upside action. So again, why I'm calling it low probability, or I think a lot of people don't think it's going to happen because they're seeing the resistance overhead. So if the market does burst above, you do have a bullish price pathway on the intraday frame. And that again is just taking us into these shorter frames. Now, if you are not trading the intraday or the short-term time frame, the question and answer is the same. We ask who's in control? Bulls in control. Why are they in control? Higher highs, higher lows, higher highs, higher lows, rising moving averages. Oh, and that thing about stocks being at all-time highs. That's part of the bull narrative also. But price does not go straight up. It waves and it swings. So number one, who's in control? Bulls in control. How likely are they to keep control? Well, that's not a positive answer. Just like over here in any example where the market runs, there typically is a short-term pullback or retracement. So that is the odds or the favored outcome for this next week and maybe even into Thanksgiving. Don't forget, we often have the turkey rally or the Thanksgiving rally, or specifically a bullish outcome to the end of November. We'll certainly see if 2019 plays that, given that we've already had a bullish start to the month. Almost, if you look at the entire month of November, just about has been straight up with maybe 1, 2, 3 exceptions there. So usually we get a pullback. Thanksgiving takes place, Thanksgiving holiday, and the market rallies through the remainder of November. That's not going to be the play this year. So the S&P is up at all-time highs. We continue to chart stocks that are making all-time highs with the market, but we are waiting. We are not going to get long. We are not going to put a whole lot of bullish positions on into resistance in an overbought market. That doesn't make sense. If you're an intraday trader, certainly you have a chance to play the breakout, but for swing traders and those with verticals, put verticals or bull call spreads, etc., this is a good time to put on bear type positions. And that's to play in the direction of probability, meaning a market that's overbought, divergent, just like the prior examples. You can't time the exact day, but those markets tend to fall or retrace. They build a base and make a run for new highs. So we're not looking for the end of the bull market. We're not bearish in any sense of the word in terms of we think the economy is going into recession. All we think is the market is overbought, divergent, and should, on a short-term basis, 1 to 2 weeks, pull back or retrace, meaning move lower. Downside targets, I think the easiest one to spot would be about 30.25 because that is a prior price pivot. So that's what we're looking for, Mr. Market. And then we can take a look at other indexes just for the quick reference. In the Nasdaq, that may take us from 8,300 to, roughly speaking, about 8,000. That's a simple number to play for on the downside. In the Dow Mini Futures, 28,000, gosh, almost there, 28,000 in the Dow Mini Futures, which means the Dow is not that far away from 28,000. That's a level. We have a trend line that takes us to about 27,000 or 1,000 points to the downside. In the Russell, now this is what you'd want to be seeing, given that the market is into resistance, has been into resistance, and we've been discussing a sell swing strategy against 1,600 in the Russell. If you prefer to trade IWM, which is the ETF, we'll take out the beginning of 2019 and just talk about its resistance level, which happens to be just shy of 160. Professionally, that's about 158, or simple math, 159 on the ETF. Downside target, again, ideally would be the low, but just play for the midpoint, as in structure your in-out spreads or vertical positioning for the market to fall toward about 152. 150 would be a good target, and all the way down, if you are more bearish than I, that would take it to 145. But again, that is to continue the sideways trading range. All these things are simple probabilities, but as traders, we look at probabilities given that 1 time, 2 times, 3 times, 4 times, that's the turning point, or the not the top of the market, but a swing lower in the market, and this would be the 5th time that this has occurred. But as always, be careful and be safe. Watch these levels. Be on guard for an alternate thesis, surprise, bullish breakout. And if that happens, I think that will be fueled, logically at least, with a lot of bears or short sellers or hedgers that are stunned by it and forced to buy back their losing positions. And in markets removed by supply and demand, probability is one factor of it. But again, keep this in mind. Odds favor just a little pullback. But if the market starts to get going and push higher, 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 we only need to look back to roughly 2017, especially the end of 2017, where things went crazy. All right, be prepared and always safe. This is Corey Rosenblum with your Theo Nightly Video for November 14th, 2019.